What's up, everybody? Welcome to the Real Estate Reserve podcast. I'm Jason Balin from Hard Money Banker, sitting across from me in his own studio, Ian Horowitz from Equity Warehouse. Thanks, everybody, for tuning in. If this is your first time tuning in, watching, listening, our podcast, the Real Estate Reserve podcast, we certainly appreciate it. We're going to make this as entertaining as possible, and hopefully you'll learn something as well. And if you are a frequent follower, viewer, listener, subscriber, welcome back. I'm glad we could earn your trust and, giving us another shot to entertain you. Today is Monday, June 26th. We like to timestamp some of these things, 2023, because we're in an ever-changing real estate economic cycle. So it's fun to circle back weeks, months, years later to see some of the topics that we talked about, some of the guests that we had, and, what was hot to talk about. So, well, first, before we jump into here, Ian, what's up with you?
Nothing. It's really hard to share. There's some things that are easier to share from the mobile site than it is on the desktop, but then it's like I'm looking, how do I share to my own page? And I don't even know how to
You
do
have
it.
you have a full-time intern for all of your stuff, so you first off shouldn't have any excuse.
I guess that's right, but I'm trying to make sure we get it shared out there so we can share the wealth. But man, it is like you said, it is fun. And I was listening to you say, we like to timestamp these, and it's not only just a timestamp it to see, like, so people know where we're at, but it's like, it'd be interesting to watch these going back and saying, man, like we were how many years in, and we recorded an episode here, and like my headspace was there, like, because just guys, so like this episode is coming completely organic from a conversation we had this morning, from a revelation that I had over the weekend, and I think it's a topic that we've kind of discussed before, but like finally conceptualizing it and having like real talk and like understanding how it works and what it does for you, and as you grow a business and how much time freedom you do or do not have. What we're about to talk to is kind of how well, I don't know, we're going to find out if this is real life or not. This is as close to as a mastermind that I can get right here inside of our own podcast studio, and that was the point of this podcast. So anyway,
Yeah. Well, so let's rehash what we talked about this morning. So the topic of today's podcast is how the 80-20 rule applies to every area of your business, probably even life and everything you do in general. But what do we mean by this? Like typically, in business, you're usually the most profitable with the top 20% of the projects you do, the clients that you work with, and things like that. And typically the 20% are the ones that are a drag on you. You probably make the least amount of money. They're the biggest headaches. They're a pain in the neck. And in essence, 20% is what you should kind of get rid of. And that's everything in business. That's everything that's everything in real estate and life as well. So let's talk about this project real quick, or this property that we co-own. When did we buy that? 2 years ago?
Yeah, we bought it late 20, early 21. It was a smaller storage property, and it was one of the first ones that we ever did. It was one of the first deals that Jason and I kind of worked together on, so it was kind of I don't want to say delicate, it's not the right word, but it was kind of like, we were getting in bed to go do this deal here. Obviously things have changed since then, but it's a smaller storage facility. It's about 14,000 square feet. It's got about an acre to develop on the site. And it's a pretty basic, like run of the mill storage facility. Like not much to do to it.
Yeah. So since then, Ian's obviously increased substantially his portfolio of self-storage facilities and multifamily buildings, commercial buildings, office buildings, things like that. He's the operator. My business partner, Chris, and I were just capital investors and limited partners in the deal. So I don't have much say in this whole thing, although I am in full agreement with him on his decision-making. But when we were chatting earlier today, and he was like, hey, I'm thinking about getting rid of, what's the name of the facility?
Denham Springs.
Denham Springs. I was thinking about getting rid of Denham Springs. And I'm like, yeah, I mean, that's fine. Like, what's the reason? And the reason is like, well, it's a smaller facility. It's kind of a pain in the neck. It's a little bit of a lag on his business partner, Dan, who does some of the back end bookkeeping and accounting and CFO related tasks. And it's just kind of not worth it. We've got a lot of other bigger stuff kind of in play. So this is a smaller facility. And keep in mind with smaller facilities, smaller clients in general, if you're in the client business, like there's only so much capacity that they can get to. There's only so big that they can get. I mean, if it's yes, this facility is developable, so you can obviously build more in it if you wanted to, but it's like Ian said, it's 14,000 square feet. There's only so much you can do with raising rents um and things like that. And I certainly feel like, and I mean, he said it, and I 100% agreed with it. Like before he even finished the conversation, I was like, "That makes perfect sense to me." Like, move on to more profitable things.
Yeah, well, and the thing is now we put some larger systems in place. Like there's additional financial burden that facility can't keep up with. There's operational drag that comes with that facility. I mean, the simple fact that we got to do a single tax return that costs us about $1,000 to do that tax return. I mean, that is a legitimate burden when your rent roll, is not that big comparatively speaking to your other sites. It costs the same to do the tax return there that it does for 250,000 square feet. So there's just some operational costs that don't make sense, and also it's like what's weird, and this is something that should be brought to light, is like we own 6 facilities within a 12-mile radius, and we're considering selling this one facility. And the reason we're considering selling this one facility is because, comparatively speaking to all the other sites, it's just too small. It doesn't work. Like it can't keep up with the rest of them. And it does take our guy a half a day to go over there and do what he needs to do and keep track of it. And it is one more responsibility. It is one more headache. It is one more everything. And usually one more is good, but in this case, one more is actually bad. So we're going to consider selling it. We talked to a broker today, and look, we bought it. We bought it with private capital. Jason and Chris were investors on it. We raised all the money through our friends and family as debt for the rest of it. Then we refinanced it with a bank. So we've already levered it up and taken some cash out the first go around. But there's an opportunity to sell it. And like not only the 80-20 rule from an operational standpoint, there's also the velocity of capital that we're going to look at, right? We can get into that.
Yeah, and also, I want to talk about that because that's a big point that I think a lot of buy to hold operators, buy to hold investors forget sometimes. They want to buy real estate and they never want to sell it. There's a lot of different opinions on that. There's, Ian and I are opposite but similar at the same. Like I think we both have opposite outlooks, but like I think the actual ultimate goal is the exact same. We just look at things a little bit differently based on our types of businesses. His business, he has, lots of equity, and, in my business, I just hit cash flow singles on a regular basis, and I don't have a lot of equity, with less property ownership than he has. But like, it's interesting because like in a 10-year time frame, I could be going like this and he could be going like that. and we're in the same spot down the road, but that's kind of a different conversation. But in general, depending on where you're at inside your real estate investing career should determine what types of assets that you're buying. That deal that we bought together 2 years ago was great for at that time, right? Like that was the size facilities that, you were buying, that you're attracted to. They were at the right price points, the amount of capital that you're raising, things like that. So it works out great. But then eventually, like anybody else, you should outgrow that. Like that was one of, that was, one of, like a marquee product for you at the point. And at this point, it's like, I don't want to mess with this, right? It's the same thing with real estate investors that are buying, whatever, a rental property or a fix and flip. You're going to buy whatever you can that fits in your comfort zone, right? How much cash do you have available? How much can you get approved for to get financed from your bank? What type of renovation are you looking for? If it's your first deal, you probably shouldn't be doing like a complete gut renovation or new construction. You should probably be doing something a little bit smaller to handle and to learn from. So I think there's a lot of learning lessons from something like that. You start where you're comfortable, you start kind of on your level, and then you work your way up. I mean, think about like the first, 10 townhouses or row houses that you purchased. Like you would never buy those anymore. But that was great for you at the beginning.
No, they give me agita even thinking about it. I was just about to say the first house we ever bought, we spent 20 grand or 25 grand, whatever it was, and we put 25 grand into it, right? Like that's insane to even think about. Like Dan and I were just talking about this the other night. It's like, from a business standpoint, like the business boner standpoint, like it doesn't even like to look at a 13,000 square foot facility doesn't even get me off. Like it doesn't move the needle. And like, it's a very grateful thing to be able to say, like, it doesn't move the needle. Like, it just doesn't do it for me. And, if you're not fully into a project, there's nothing wrong with that. Like, there's nothing wrong with saying, yeah, dude, like, I'm in and I'm out. Like, I got to do my thing. So,
Yeah, I mean, well, think about this. A big real estate developer, they're not going to go buy $100,000 rental property row house where they could have max, $600, $800 a month in positive cash flow, right? To somebody that sounds like it's great. I would love to have that, right? And somebody else might have the opinion of, yeah, well, that's just one, and then I can buy 5 of them or 10 of them or 100 of them. But as you grow, things change of what you're interested in. Like, you don't want to waste your time in that. I remember early on, Chris and I were friendly with a really big Baltimore developer, and I never understood why he wouldn't do some of the smaller deals, and he would do 3 deals a year, and these were gigantic acquisitions, like things that that REITs typically own, like commercial shopping centers in Columbia, big hotel projects in the Inner Harbor, things like that. And he would spend, 7 figures a year on, marketing, payroll, things like that. He did 3 deals and he had like, I don't know, a dozen employees. Like some years he would do 1 deal or 2 years. And that's what it was. It was massive. And I'm like, well, why don't you just start doing some little deals just to like pick a part of it? It was like, no, I'm keeping my attention on this. And it was interesting.
Well, and the other thing is like your team's going to become disengaged with some of this stuff. It's like, oh man, that's a nuisance. It's a nuisance to us. It's a nuisance to them. But also the resources being allocated, right? Like when you're looking at gigantic shopping centers or gigantic whatever it is, or something that's what you want to do for someone else is not what they want to do. And you stay in your niche and you carve yourself something out. Like obviously you have a perfect borrower that you guys have identified that you continue to lend to. We have a perfect facility size, whether it's multifamily or self-storage, of what works for us, because guess what? There's resources and team members that need to be employed. And I don't want to do busy work. We would rather do something that's meaningful and purposeful to the team for everyone to work towards a common goal, and when we heard someone say, and I think it might have been Jason, I don't know who it was, but they're like, every year you should just comb through your portfolio, do the 80-20 rule, drop the 20% and level up. Like this becomes holistically more than just, well, we're dumping this facility because it's a nuisance. Well, no, it's not really a nuisance. It's a cash flow. I don't have to sell it, but I should sell this facility for the velocity of capital and to jump asset classes and to continue to grow. Like going back to the conversation of, I don't want to buy another house like when we first bought houses. Like we did that out of need and necessity. Now it's like, okay, well, we have the wherewithal and the financial ability to buy something nicer that's less headaches. There's always going to be headaches, but like it's less headaches. It's a better quality asset. There's more pride of ownership. There's more longevity. There's generational wealth. There's all these things that come with it by moving up asset classes. And I think too many real estate investors are like, I bought this property. I'm in it for the long haul. I'm never going to sell it. And that's really just a fear that they're scared to be confident to be able to do it again. And we have the confidence that if we sell something, we have the confidence that we'll go find a deal at market and we're not worried about it.
Yeah. I mean, I learned a long time ago from one of my mentors is that you always trade up asset classes. You buy whatever asset class you can, whatever asset you can now, and then you work your way up. And that's the beauty of 1031 exchanges and things like that. And just because your first storage facility was purchased 2 years ago, that doesn't mean that you're fresh and you're new in the game. That was just that asset of self-storage. There was office and multifamily, and then there are industrial and other stuff that you had owned before that. But when you started dipping in self-storage, your first facility wasn't, whatever, 100,000 square foot facility. You started small at a 14,000 square foot facility, and then you worked your way up to, 500,000 or so in square footage. And that's where it goes. Something else on this topic that I thought was interesting. And One thing that I heard a long time ago that I've always agreed with, and it's funny because I listen to a lot of Alex Hermosi's podcast, The Game. Shout out to you, Alex. And a thing that the last few episodes he's mentioned, and I agree with this, and I'd heard this obviously a while back, but the difference, and this is like if you do client work, let's say you're like a real estate agent or something like that. Because listen, if you're a real estate agent and you're in an area in Potomac or Bethesda and your average house sales $1 million, you're typically not doing much more additional work than somebody who might be in completely Western Maryland and their average home sales $100,000, right? And you're making 10x the amount of money for the most part, and maybe probably not doing as much work. But one thing Alex mentioned, and I agree with this, is think about if you're selling some sort of product or like coaching program, or let's say a service, right? And you sell it to somebody and the cost of your product's $50. The person that you're selling that $50 product to is going to be like, oh, for $50. So what do I get? What's your guarantee agreement? What happens if, it doesn't work? Can I get my money back? How are you going to hold, how are you going to help me with this? How much time do I have? Like, right. They're going to ask you 100 questions compared to like a $50,000 coaching program or service. You're going to get a text message from them and says, hey, my wire sent,
Right.
It's looking forward to working with you. And I see that because we do that types of stuff as well. It's just a higher quality client that you're working with, right? That's usually what happens. And that's what we're kind of gearing this towards. At least, the 20% of the headache stuff, you don't want to deal with headaches. We're mature enough in our businesses that, and take our word for this, if you're just starting out in business or real estate investing, that like, you don't want to deal with the headaches over and over and over. Right? Like, I don't want to go into a loan that I think is going to default, or I'm going to have to potentially go to foreclose on, even if it's a humongous moneymaker. Even if I'm doing a loan for $100,000 on $1 million house, if it's going to be a headache, I don't want to deal with it. And that's maturity inside your business. And I think that has a lot to do with this. You're a real estate investor. It's the same thing. It's like, you know what? This is a great cash flowing asset, but it's going to be a pain in the neck. And then I'm not going to be able to evict them. And then I'm going to have this issue and this issue and this issue. It's not what we're doing. I mean, our quality of loans have increased tremendously in the last 16 or 17 years. And when I say that, it's not necessarily because we're doing better deals. We're doing cleaner deals that are less headaches. We don't, typically ever lose money on deals. We write good loans, particularly hopefully to the right real estate investor, and it works out fine. But the point is like, I don't want to do anything with a headache. I don't want people missing payments. I want to write the good operators that I know are going to pay off, even if we make less money on them. Because keep in mind, like, defaulted borrowers to banks, even though they're headaches, but they make more money, right? There's late fees and extension fees and things like that. But in our business, I'd rather just keep it super clean with no headaches and just keep it moving. And I think that's what a lot of people that are mature in business eventually want to strive for.
Yeah, and I think a good way to frame it up for everybody, especially if you're local, is like, the 20% of the loans that you might do in the city, or you did in the city, or tougher areas, let's say it that way, you could have gotten more points. You could get more junk fees. You could get more everything. You could get more margin and spread on them. But it's not worth your time, energy, and effort. And you guys made a business decision to not do certain areas, which is fine because it's your capital. You can do that. In the same sense, you carved out a niche to say, I'm the front runner in DC or Baltimore County or these markets, and I'm really good at this. And it's the same thing for us. It's the same thing for every real estate operator, is identifying what you're good at and just cutting away the bottom. Got to cut away the bottom. And that could even be hiring an employee. Man, I get this 80% done really well. I hate this 20%. Go hire someone to pick up that 20% because they'll be really good at the other 80%. And you're going to pick up the other 20% because it doesn't fit in their buy box or it doesn't fit in their workload. And I think this rule can be applied over and over and over again. And, we were talking, Dan and I were talking over the weekend, and I think it's time that our portfolio is large enough is like, we have to make some hard decisions going forward and take the 80-20 rule and just say, hey, the bottom 20% of the worst performers, we might have to remove them from the portfolio continually here. But what it does is it recaps the portfolio, cash comes in the door, we get to go redeploy it on new and better and hopefully better quality assets that now we're churning and we're turning that 80-20 over and over and over again to hopefully start buying some Class A assets once we have some more firepower under us. And it's just a matter of time. And I don't think a lot of people stop and think about what it takes, or some of those bottom level assets might cash flow really well, but someone's willing to pay for that cash flow, and you could pick up a big chunk of equity and turn around and buy something bigger and better, right? And it keeps you moving up the chain, and now the velocity of the capital. And it's just building the business and building what we have today allows us to give us more choices, more options, because we get to view all this stuff on a daily basis because we have the portfolio to determine it versus not having a portfolio to determine it.
Yeah, and I'm going to show you this ghetto pyramid that I just drew. If you're watching this, if you're listening to this on iTunes, continue to do so and enjoy.
You really need to get on and watch this one. It's high quality.
You can always go to our YouTube channel or our Real Estate Reserve podcast.com as well. So anyways, it's just a regular pyramid. And at the top is your most profitable 20%. That's typically what it was. And at the bottom is your least profitable / annoying. And you got to chop that off. Right. And then in the middle range one, you can choose to decide to do those deals or not. Listen, there's an argument that if we stop doing every loan under $1 million inside our business and we only concentrated on the $1 million plus loans, that maybe we make more money, be more profitable. But I mean, I'm not saying we're doing that. I don't have the balls to do that. But the point is like, there's an argument that like that would be an interesting test. We don't typically do, too much small loan amounts on a lot of these deals anymore, just because they've kind of been a headache, and we've learned from experience. And I mean, we've had to have uncomfortable conversations with some of our business partners where they're like, yeah, but I like some of these real little deals. We just do them like it's not much more work. And it's like, well, it could be more work and there could be more headaches. So, and also, our employees bitch about them because their time sucks and they don't like dealing with that clientele. So they're less qualified. So there's more to they got to take in consideration with just making an extra few bucks on something.
Yeah, well, too many people are greedy, right? They're not mature enough. And I mean, I got the same problems. Like, oh shit, I wouldn't mind buying that. Who cares if it's in the hood, or who cares if it's in this area? I can deal with it. We've always dealt with it. But now it's like, man, like that shit starts to wear on you. Like, dude, I didn't get gray hair from buying super nice quality stuff, but we needed cash flow up front, right? So it's like you have to go through that. You have to earn your almost your stripes, dude. Like you have to take that journey. And guess what? You think it's just us sitting down here, the little guy, like working through the stuff we have. You don't think Uncle Donald, having all the big buildings he had, didn't have those conversations, right? Or Sam Zell's another one, right? You don't think he sat around with all his high quality assets? He didn't sit around and say, man, this shit's an operational drag. Get it out of the portfolio, right? Like these conversations happen at every single level.
Yeah, every level. And real quick, and if there's any questions or if anyone wants to chime in related to this topic, I'd love to have you on the show. Love to answer your questions. You can chat them, or I can send you a link and you can hop on here with us. But let's talk about the velocity of money thing a lot. And I don't know if that's the right term in this particular case, but I think about that all the time. And I think about, let's use Denham Springs, for example, let's say, and again, we already did a cash out refinance on that property. And I don't want to say that we bled it and took a lot of cash out, but we already took cash out of that thing, right? We already got a win and all the investors got their money back. So we're good, but there's also a few $100,000 left over in equity as the property sells. And again, this is a 14,000 square foot storage facility. It's not that big, right? Like there's only so much, so much value that could ever get. So one side of it is, hey, it's a good property. It's a good area. We could potentially keep it going. And in the future, we could, get more on it. It'll just cash flow. It'll cover itself. And eventually, it's real estate. It'll just keep going up in price, right? That's one side of it. The other side is let's just take all the cash out right now and walk away from it, because, a few $100,000 now guaranteed in your pocket might be better than whatever the alternative is in the future, right? There might be a point where like we need to sell it and we can't, or it could go down in value or whatever the case is. So I'm all about, hey, if there's, a good pile of chips on the table right now, take it out and move on to the next thing, right? Because I feel like I'm pretty opportunistic. I have an investment vehicle in my hard money lending company that I could lend the money back out. Yeah, we're going to get stuck with taxes, since chances are we're not going to do a 1031 on this particular deal. But the point is cool. I think if we went into this deal or any deal and it's like, hey, are you going to make this, and the amount of money that we made on that deal in 2 years? Yeah, of course we would have taken it out. So like, let's take it out and let's move on to the next thing. But I do understand buy and hold investors' mindsets. And I don't know. My mindset is, hey, there's a few $100,000 of not free, that's not the word, unexpected maybe, money in 2 years.
Unrealized gain. You're capitalizing your unrealized gains, right? And every market there's a place to sell, every market there's a place to buy. So it's not really a big deal. And the way I look at it is, I know you said 2 years, but it's got to be north of 5 years of cash flow to sit there and say, listen, man, like, here's the distributions we've been receiving. Here's the distributions we can expect. But in 5 years' time, the increased value is X. We might need to sell this if we can capitalize 5 to 7 years of cash flow. If not worth our time. But that also allows, when you're comfortable in your business and knowing what 20% you want to drop, makes you a better seller. And you can say no to the market, right? Because you're already operating. If we take this to market and we don't get close to the price we want, well, then you know what? So be it, right? And I had that conversation with the broker. I said, here's the price we're expecting. Let us know if you're willing to list it for it. But we're confident enough. Like, look, if they say no, I go back and say, hey, Jason, listen, the guy won't list it for this. We're going to wait around. All right, cool. We'll just sit on it. We'll earn our tax benefits. We'll earn our cash flow. And it'll be fine.
No doubt.
And if not, but again, this is understanding this is a whole nother holistic conversation. And we don't have enough time to get into this. This is probably like a 10-part series, but like knowing your business, knowing your numbers, knowing what you want to do, knowing what your investors' expectations are. And Jason knows, Jason, honestly, how many properties have I sold that we went in to buy as a rental that we've actually sold? I think the answer is none, maybe one. Like every deal we've ever bought to sell, we've sold. And every deal that we bought to rent, we've rented. And like, for us to have this conversation, it's a level of maturity, but it's also a level of understanding of our business and everything that goes into that,
And things change and markets change. I mean, there's also an argument that, hey, we're at the top of the market, although we probably would have been saying that for the last 5 years.
Yep.
But you do whatever. I look at it like this: okay, let's think about it. If you are selling a product to somebody in general. So let's say you can sell a product to somebody, you get paid $5,000 today, guaranteed today, tomorrow you get $5,000, or you wait a year, multiple years, and you could make, I don't know, $10,000. You can make twice as much money, but it's not guaranteed. There's risks. You wait another year. Like, what do? Do you take the 5,000 now? Do you take the 10,000 later? And at that amount, that's a big spread. That's double. That's 2x. Yeah, maybe you wait. But like, if it's 5,000 now or like 7,000 later, probably not. I mean, I know inside my investment vehicle what type of returns I can spit out, and I'm hoping that everybody who's listening or watching knows that as well. And if they don't know, figure out what your actual capital is worth to you when you're investing in an asset. If you're investing in a real estate flip or a rental property or a private note or whatever, however you invest in the stock market, or however you invest your cash, what that's worth to you. And typically, like, I can double my personal capital as an active investor in 3 or 4 years. That's typically what I strive for. So, if I could make $5,000 now or 10 grand in 12 months from now, maybe I take the risk and do 10 grand. But like, I'm not going to be like, hey, I'll take $5,000 now. And, or I wouldn't be like, hey, I'm not going to take $5,000 now. I'd rather risk to make 6 or 7 later. I just think on this case with this storage facility, it's guaranteed, even if the thing continued to cash flow over and over and over, it would take whatever, a dozen years.
Yeah, I'd say it's probably 10 years of cash flow. If we sell it,
a dozen years.
We sell it at the expected price. We're talking about 10 years of cash flow. And it's like, yeah, sure, we could take it as a hit, but then there's also the diligence to say, okay, well, we're going to pay ourselves a little bit of money. And yes, Jason and Chris, if you guys want a 1030, this is a unique situation because it's one-on-one. Hey guys, if you want a 1031, we'll figure this out. Here's what we got a 1031, and this is what we got to do. Or we could also say is, all right, man, we're going to take that hit. We're going to pay the taxes. But guess what? That money is now for those. We could buy 4 of those same facilities. You think about this. We paid $350 for that thing. And if we walked away with like, just say 300 grand, just for quick round numbers, we could buy 3 of those same facilities with that same amount of money. And those are just ancillary numbers, but we could buy 3 of the same facilities for what we got from one. So now it's like, well, if you do want to grow and scale, you don't know where to find other capital from. There's an opportunity. It's the same thing in single family. You might be able to sell a house for 50, make 50 grand and turn around and go buy 4 more houses with that same 50 grand or 10, 2 more houses.
That's right.
And then it just stacks up and it grows and it grows and it grows to the point where you have volume, you have scale. And then it's like, all right, well, I want to do this. And it's plug and play. And it truly is real life monopoly. And not enough people take the time to work through it. And I think this all goes back to really just being comfortable in your business and understanding your numbers and understanding what your business does and does not do. And I think too many real estate investors as a whole just treat it like a hobby. They get to a certain level, they're comfortable. Yeah, cool. I'm living off 10 grand a month. All right, well, cool. What's 10 grand a month today is about $1 10 years from now, right? So we don't know where the market's going. Why wouldn't you take the time, energy, and effort to use that $10,000 to potentially sell something off, get a $100,000 hit, and now make that 100,000 spit you out 20 grand or 30 grand.
Yeah, that 10,000 can turn into 11,000 a month or 12,000.
Oh, did I send
14, 15 a month? Yeah.
Yeah, I sent you that. I sent you that clip. I got to go dig and find it. It's too short a notice. Maybe I have
when
it right here.
when he interviewed that woman.
Yeah, and she was talking about
that was going to marry a rich guy.
Yeah, and she was talking about abundance, right? Like this is about abundance. It's not about greed. It's not about wealth. It's not about any of that. It's about abundance, right? Like it's about growing. And it's the same thing applying this 80-20 rule, dumping off your lower level stuff is about creating abundance, right? And if you have the opportunity to grow your portfolio that creates additional abundance, like why wouldn't you do that? Too many people use the word growth and wealth. And when I heard that clip, I was like, that sums it all up right there. You're growing this thing to create abundance of wealth, abundance of purpose, abundance of mission, abundance of whatever you want it to be. And I was like, man, that clip right there hit me hard. Like that summed it all up, because too many people are like, oh, you just want more money. No, I don't want more money. I do, but I don't. Like, that's not what it's all about. Sometimes it's about the team. Sometimes it's about the investors. Sometimes it's about us as human beings having purpose and growth, right? So I thought that was a really, really powerful clip. I think it was Brad Lea. I don't know how to say his name, but anyway, it was good.
Lee or Lay, I don't know. I've watched some of his stuff.
Yeah. So
yeah. All right. Well, listen, hopefully everybody got, some takeaways from this episode related to, the 20%, the 20% rule, because it's something that's top of mind for me, inside our business a lot on everything, right? Typically, the top 20% of your clients are typically making you the majority of the money, and usually the easiest ones to deal with. So in a perfect world, you keep your top 20, you get rid of all the bottom 80, but let's start small and just start getting rid of the bottom 20 and concentrating on your top 20. I think just by mentally being aware of that, of, hey, these are the 20% of my best assets. These are the 20% of my best clients. These are the 20% best customers, my best employees, best everything. Doesn't matter, right? And these are 20% of my worst. Like, start with that. I think that's a good first spot.
Yeah, I'm headed out. I mean, dude, we nailed it. We nailed it on the head. I mean, and the reason we do this podcast is literally what's top of our mind. And sometimes we have guests, and sometimes we just talk about it. And we were talking this morning, and I was like, "Hey, man, Jason's like, we need to do a podcast this week." I was like, "By the way, we just talked about this. Like, this is like really fresh in my mind. And it's a great way to work it out." I am headed out to go visit Farling on Wednesday, and we're headed out to DM's event. So that should be interesting. And it'll be interesting to see how other business owners talk, right? Like, it's not just gonna be real estate investors. It's gonna be all types of business owners. I think everyone in that room is going to be able to talk about how they apply the 80-20 rule to customers, clients, real estate assets, business assets, digital assets, all of it. So yeah, it's going to be a good event, and I just appreciate having an outlet to talk about exactly what we got going on in our business at any given time. So
exactly. Any future topics that you'd like to hear, feel free to comment on any of our videos. realestatereservepodcast.com is our website where you can watch all of our past videos, and make sure to search us up on iTunes. We appreciate all the feedback that we get. Definitely appreciate all the questions that we get. Joke that Ian and I have is if we're not talking publicly live on camera, we're just going to be talking to ourselves secretly. That's typically what happens about these exact same topics anyways. So we enjoy sharing this stuff, and we'll continue to do so. Mike, appreciate it. Thanks for the support, and we will we'll chat soon. Cool. Later, guys.
peace.
Thanks for tuning in to the Real Estate Reserve Podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time, thank you for tuning in.